If you're trading off basic support and resistance lines, you're trading blind. You might see a sudden break through a key level, but without knowing the exact weight of the money pushing that break, you're guessing. To see what's actually happening, we have to look below the price action to the volume spikes driving it. But here is the problem most traders run into. If you are looking at standard Forex or CFD broker charts, you are looking at fabricated data. Because there is no central exchange for these brokers, the volume you see is just an isolated snapshot, not the true global market. To map where institutional money is actually deployed, you need data from official futures exchanges. If they're trading gold, you need to pull up the Comex or CME Group futures ticker. This ties your chart directly to the physical assets moving through the real financial system. Once you have accurate data, you can spot standard divergence. This chart details a classic pattern. If the price is climbing higher, but the volume is dropping below its average, the trend is losing its underlying strength. A sharp drop is usually right around the corner. Finding that authentic data and reading those basic divergences is the first step. That gives us the foundation we need to map the market exactly how institutional players do. To build that map, we use the fixed range volume profile. You anchor this tool from the exact opening bell to the exact close of the previous trading session. If you are trading Monday, you pull Friday's data. This generates a histogram on the side of your chart, showing where trades were concentrated. If the bulk of the volume sits at the top, forming the shape of a letter P, the market is carrying a strong bullish bias into the current day. Conversely, if the volume accumulates at the bottom, mimicking a lowercase letter b, you are looking at a bearish setup. Identifying these daily shapes keeps you aligned with the broader flow of capital, so you aren't fighting the primary trend when you drop down to execute specific trades. Inside that profile, you will spot distinct valleys in the histogram. These are low-volume nodes, or LVNs. Because very little trading happened here previously, they act as areas of low friction. Because of that lack of friction, LVNs are not meant to act as support or resistance. Their structural purpose is to be broken. That makes them your primary target for breakout setups. But you don't enter on the first touch. You wait for a 5-minute candlestick to fully close outside the zone. That candle close is your mechanical confirmation that the break is real. Once that candle closes, you execute. Without historical volume to slow it down, the price shoots through the gap toward the next major level. Treating LVNs as high-speed transit zones gives momentum traders a precise, repeatable entry mechanic. On the opposite end of the spectrum are high-volume nodes, or HVNs. The absolute largest peak is your point of control. These are zones of extreme friction and massive liquidity. Never trade a breakout directly into a high-volume node. The institutional money sitting there will absorb the momentum. Instead, watch as the price pierces that level, triggers stop losses, and then violently reverses. This is a trap trade. You are waiting for the exact moment retail traders get caught on the wrong side of the wall, letting you enter safely on the reversal. Let's test this out. Look at this fresh profile from a new session. You have 5 seconds to identify the daily bias and spot the exact valley where a breakout trade should trigger. The heavy capital at the top gives us a clear P shape, meaning a bullish bias, and right below it sits the low volume gap where our breakout entry waits. Reading the topography this way stops you from reacting to price and lets you predict it instead. Let's pull the entire cycle together. It's Monday morning, and before you place a single trade, your first step is pulling the fixed range profile across the entirety of Friday's data. You run an immediate diagnostic. The profile forms a P shape, giving you a bullish bias. You mark high friction peaks to avoid traps and isolate low friction valleys for targets. Now watch the live execution. Price pushes into your marked valley. The underlying volume bars spike green, and a 5-minute candle closes cleanly above the line. That is your signal. You ride that upward momentum straight through the gap until it hits the friction of the next major node. Keep this checklist on your desk. Here are your exact parameters. Secure real futures data on a 5-minute chart. Identify your daily shapes. Target the valleys for breakouts, and use the peaks for traps. Mastering the volume profile strips away the noise. It turns a chaotic market into an architect's blueprint, telling you exactly when to step in and exactly